Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out if companies are secretly hiding a pile of cash or a mountain of debt by reading their financial reports. Today we are diving deep into Enterprise Products Partners LP and their latest quarterly report, also known as a 10Q filing. We will be looking at some big numbers and trying to make sense of what they mean for you. Before we dive in, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we break down more filings and answer your questions. Alright, let's get into it. We are looking at their balance sheets for the third quarter of 2025 and comparing it to the end of 2024. The first thing that catches the eye is their total assets. They had about $77.8 billion in assets at the end of September 2025, which is up slightly from $77.1 billion at the end of December 24. That is a lot of stuff, but what does it really mean? Their accounts receivable, basically money customers owe them, decreased from $9.2 billion to $7.5 billion. That is good to see that money is coming in. Now, their inventories, which is the stuff they have on hand to sell, increased slightly from $3.9 billion to $4.1 billion. This could mean they are stocking up for future sales. Their property, plant, and equipment, which is their infrastructure like pipelines and facilities, increased significantly from $49 billion to over $51 billion. They are investing heavily in their physical assets, which usually means they expect future growth. On the other side of the coin, their liabilities are also important. Their current debt, the money they owe that is due within a year, jumped up quite a bit from $1.1 billion to $2.4 billion. They are taking on more short-term debt. Their long-term debt is also up slightly from $30.7 billion to $31.1 billion. Overall, debt is a big part of their financial picture. Now let's talk about equity. Their common limited partner interest, which represents the owner's stake, increased from $29.7 billion to $30.2 billion. This reflects the growth in their business and retained earnings. Moving on to the income statement, we see total revenues for the third quarter of 2025 were $12 billion. This is down from $13.7 billion in the same quarter last year. This drop is a key highlight. Looking at the segments, NGL Pipelines and Services saw revenues drop from $4.8 billion to $3.4 billion. This is mainly because they sold less NGLs and related products. Lower prices and lower sales volumes are the culprits here. Crude oil pipelines and services revenue actually went up a bit from $5.2 billion to $5.3 billion. While volumes increased, lower prices pulled the overall revenue down slightly in this segment earlier in the year. But this quarter looks a little more stable. Natural gas pipelines and services saw a big jump in revenue from $649 million to $932 million. This is driven by higher sales of natural gas itself and increased midstream services. Petrochemical and refined product services revenue decreased from $3 billion to $2.2 billion. Again, lower prices and volumes here are the main story. Their cost of sales, the direct costs of producing or acquiring the products they sell, fell from $10.3 billion to $8.5 billion. This decrease aligns with the lower revenues as less product was sold and the cost of acquiring that product was also lower. Depreciation, amortization, and accretion expenses, which represent the cost of using their assets over time, increased from $601 million to $643 million. This is expected as they continue to invest in new facilities. Interest expense, the cost of borrowing money, went up from $343 million to $354 million. This is directly tied to their higher debt levels and the new notes they issued. All these factors resulted in income before taxes decreasing from $1.45 billion last year to $1.34 billion in the third quarter of 2025. And finally, net income attributable to common unit holders, the profit for the owners, decreased from $1.41 billion to $1.33 billion. This translates to about 61 cents per common unit, down from 65 cents last year. It is not a huge drop, but definitely a step back year over year. Shifting gears to equity, their total partners' equity ended September 2025 at $30 billion, up from $29.5 billion at the end of 2024. This growth is mainly due to retained earnings from operations. Interestingly, they repurchased common units under their 2019 buyback program, spending about $80 million in the third quarter of 2025. This shows they are returning capital to shareholders, which is always a good sign. They even announced an increase to this program in October 2025, boosting it from $2 billion to $5 billion. That is a big signal of confidence. Now, let's look at their hedging activities. They use derivatives to manage risks from changing commodity prices and interest rates. For their commodity hedges, they have a significant number of contracts in place, particularly for natural gas, NGLs, crude oil, and petrochemicals. These are crucial for stabilizing their earnings. When we look at their sensitivity analysis for commodity derivatives, a 10% increase in underlying commodity prices would lead to a negative impact of $15 million on their natural gas marketing portfolio at the end of September 2025, assuming these were liabilities. However, a 10% decrease would result in a positive impact of $7 million. These numbers highlight how volatile their earnings can be based on commodity price swings. Looking at their business segments, the NGL Pipelines IAMP Services segment continues to be their cash cow, generating $1.3 billion in gross operating margin in the third quarter of 2025. However, this is a slight decrease from $1.33 billion last year. The Natural Gas Pipelines and Services segment showed strong growth in gross operating margin, up from $954 million to $1.1 billion. This growth is fueled by increased volumes and improved fees, especially from their Delaware Basin assets. The Petrochemical and Refined Product Services segment saw a significant drop in gross operating margin, from $1.19 billion to $1.03 billion. This is mainly due to lower performance in their propylene production and octane enhancement operations. When we look at cash flow, net cash provided by operating activities was $6.1 billion for the 9 months ended the 30th of September 2025, an increase from $5.7 billion in the same period last year. This shows their core operations are generating more cash, which is a positive sign despite the revenue drop. However, their investing activities show a substantial outflow of $4.3 billion for capital expenditures, up from $3.4 billion last year. They are pouring money into growth projects like new natural gas processing trains and pipeline expansions. This is a big bet on future growth. An interesting detail is their related party transactions. They have a significant administrative services agreement with EPCO and its affiliates, essentially paying them for management and operational functions since Enterprise Products Partners LP has no employees. This is a common structure for MLPs, but means a large chunk of operating costs are tied to related parties. Now, it is not all sunshine and rainbows. Their risk factors section points out that changes in US trade policy and tariffs could negatively impact their business. This is a real concern, as tariffs can increase costs for materials like steel needed for their pipelines, and can also lead to economic uncertainty and reduced demand for their products. So, what is the verdict on Enterprise Products Partners LP based on this report? They are a giant in the midstream energy sector, and their core infrastructure business remains strong, as evidenced by the growth in natural gas and NGL midstream services. The heavy investment in growth projects signals a belief in future demand, which is positive. However, the drop in revenues is directly tied to lower commodity prices, which is a double-edged sword. While it lowers costs, it also reduces the profitability of their marketing activities, which are a significant part of their business. The increased debt levels are something to watch, especially with rising interest rates, although their long-term maturities provide some comfort. The continued reliance on related party transactions for operations isn't ideal, but it is a structural feature of their MLP model. Overall, Enterprise Products Partners LP is a fundamentally solid company navigating a challenging commodity price environment. The strategic investments in growth assets and the commitment to returning capital to unitholders through buybacks and distributions are positives. However, they remain exposed to the volatility of energy commodity prices and the broader economic impact of trade policies. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.